2020, we've seen like growth stocks such as Tesla surge to like nearly 1,000%, whereas value stocks like PepsiCo were really consistent, going from 5 to 10% return. But in the recent market correction, we've seen Tesla stock go down, like I believe it's like 50% or 40%. Dividend stocks such as PepsiCo go up higher than that. I think some dividend stocks went 10 to 20%, whereas growth stocks went down. So what's better, growth stocks or dividend stocks? So let's go through this. So growth stocks like Tesla tend to focus on the growth of the company and tend to outperform the market. That means they can go up really fast and down really fast. So dividend stocks like PepsiCo tend to focus on the general health of their company. They tend to invest their profits not into the business, but invest a portion of that to their shareholders. So the first pro is that they offer tons of potential. But in 1 year, Tesla went up 628%. And we compare it to a dividend stock, then it went up 14%. So that's the first pro. So the second pro to growth stocks is that it is really fun to research. When you research growth stocks, you look at their future potential. To me, that is really interesting. For dividend stocks, you don't really look at their future. You just look if they've been consistent throughout the years. We research stocks like Tesla, we look at their potential. We know that the EV industry is going to grow, so that's why this is a good company. Whereas dividend stocks like PepsiCo, they offer like beverages like Pepsi, the drink, and like snacks like what's those chips called? Frito-Lays. So we don't really look at the future. We know that people are going to continue to consume these items. I think this company has grown their dividend for the years they've been public, so we really look at their consistency rather than their future. They're not going to grow as much because they're investing their money into their shareholders, paying them dividends. Interesting to research because we look at their potential in the future. I'm going to move to the cons of growth stocks. So the first one is that they're really volatile. So this year's correction, Tesla went down nearly 40%, whereas dividend stocks such as Pepsi, they went down only 10%. So the second con of growth stocks is that you tend to pay a high price for them. Look at Tesla. So they have total revenue in 2020 Q4 of 31.5 billion. So Pepsi has more revenue than Tesla, but Tesla is at $661 a share, whereas Pepsi is only $141 a share. So basically growth stocks face this notion of, oh, is Tesla too expensive? Should I wait for it to drop? They're saying it's really cheap, so that's why invest in Pepsi over growth stocks like Tesla. That is basically the last con. But in my opinion, don't base your investing decision based on this overpriced notion of Tesla being more expensive than Pepsi, even though Pepsi has more revenue. Back in 2020, when Tesla was $60 a share, they said it was overpriced, so you should sell Tesla. Where did Tesla go from there? It went straight up. So I want to base my decision based on this overpriced notion. First pro to dividend stocks is that they are less volatile than growth stocks. When there is a market crash, it is less likely to fall as much as growth stocks. So we've seen the last month, like growth stocks such as Tesla, they went down nearly 40%. Whereas dividend stocks, they actually didn't go down as much, some actually went up. The next pro to dividend stocks is that they offer you cash flow. For example, growth stocks like Tesla do not offer dividends, whereas dividend stocks, they pay you a dividend. So for example, Pepsi pays a 2.89% dividend, which is $4.09 each year. So for each share you own of Pepsi, you get paid a $4.09 dividend. That is really good compared to growth stocks. They usually don't pay dividends. So that is the last pro of dividend stocks. So the first con to dividend stocks is that it's not guaranteed. Some stocks can cut the dividends and you'll no longer be paid this dividend due to unforeseen event. The American Airlines, they used to pay a 1.67% dividend from 2014 to 2020. The beginning of 2020, which we know was the COVID-19 pandemic. So due to this, they cut the dividend. So that's what I mean, that dividends can be cut. So that's why you should invest in good quality companies who have lots of cash on hand that can afford these dividends, even though there is like a pandemic such as the COVID-19. Next con is that you are taxed compared to growth stocks. So when I get paid a dividend, I'll pay both a US tax and an NZ tax. That could be an issue if you're a large income earner. So let's say my income is $70,000 and I earn $10,000 per year from dividends. I would get taxed 15%, which is the United States tax rate. So get taxed 33%, which is the max you can get taxed in New Zealand. So that means I'll be paying $4,800 in tax per year. That is quite a lot of tax. So that's another con of dividend stocks. The next con to dividend stocks is that they have less price appreciation. For example, we've seen Tesla go from $60 a share to nearly $1,000 a share. And dividend stocks such as PepsiCo have not been up that much. So basically, if you want to grow your money in terms of your capital, do not invest in dividend stocks. So now I'm going to help you decide which one is better. So let's say you want capital appreciation and you want to grow 10,000 and 200,000 in a couple of years. Growth stocks would be a good option. They are high risk, high reward. So if you want high risk, go for growth stocks. That is the best possible way to increase your capital. So let's say you invested $10,000 into Tesla last year. You will now have $60,286. So that's what I mean by high risk, high reward. Whereas if you invest in Pepsi, you would only have $10,772 in, but then you would have made $289 in passive income. I know that's not much, but it builds over time, so you really need to know what your goals are. Next scenario is you want passive income. Let's say you have $10,000 and you want to be able to earn $1,000 per month in passive income, eventually to $10,000 per month in passive income. So the best option is to invest in dividend stocks because they pay you dividends, where compared to growth stocks, they do not pay you dividends. They focus on the growth of the company. So that's basically my thoughts on what you should do if this is your goal. So this strategy is really long term. So this would be probably when you retire. Invest $10,000 with no additional contributions into Pepsi. You would have a total of $41 million in passive income. $41 million after 50 years is pretty. For this one, make sure you invest in good quality companies because sometimes they can cut the dividends. Last strategy is my personal favorite. It is you want diversification. So you want both growth stocks and dividend stocks. So to me, this is really safe because we've seen their sector rotation to dividend stocks. You have $10,000, you want to invest in passive income, and you want stock appreciation. You could split that between the two. Invest $5,000 to Tesla, $5,000 into PepsiCo. That will give you both stock appreciation and passive income. And if you do that consistently, you'll be doing well. So to me, it's my personal favorite. So the reason I think this is really safe is because you're not relying on one sector. You're not relying on growth stocks alone or dividend stocks alone. You have two. So let's say if one goes down, your other one goes up. So it balances your portfolio. So that's the end of the video. That's my whole talk on dividend stocks versus growth stocks. There's no right decision. You need to know your goals if you want stock appreciation or passive income. So feel free to subscribe to my channel if you want to see more videos like this. Also feel free to like this video. Some of this go to large ones so more can learn about investing in finance. So that's it from me. Hope you guys have a wonderful day today. See you guys in the next one. Happy investing.